Hello, this is Connie Belden, and in this chapter we're going to be dealing with decision making. You make decisions in everyday life, some without thinking about them too much, like where am I going to go for lunch, and others you do a little more research on, like if you want to buy that new car. You look at many things when you decide on something, such as lunch. You may think about cost of how much that lunch will be, but you might also take a look at how far you're going to have to drive if you want to go to a particular restaurant, or how long it might take you to get served. Those might also be considerations. If you're going to buy a car, besides the cost of it, you might consider reliability, safety features, etc. So the first thing we're going to take a look at before we talk about decision making in businesses, we're going to look at several different types of decisions that businesses make. We're going to take a look at what costs should be considered relevant in that decision making and what costs are not. So let's assume you're ABC Company and you purchase a used automobile for $23,300 at the beginning of the year. So let's take a look at, first of all, the fixed cost. First one would be depreciation of $4,660. And let's assume we got that by taking cost divided by its life in years of 5 years and assume no salvage value. Insurance, a fixed cost of $2,400. We pay a rental fee at a garage to store our vehicle for $1,300 a year, and tax and license on it, a fixed cost of $640. So I've highlighted in yellow my fixed cost. Variable operating expenses, 13 cents a mile. Assume that could be for maintenance on it, gasoline, that type of stuff. Okay, now what we want to do then is we want to take a look at what is the average cost per mile. Assume the company car was driven 18,000 miles last year. Compute the average cost. So the first thing I want to do is I'm going to add my 4 fixed costs together. I'm going to add 4,660, 2,400, plus 1,300, plus 640, and then divide it by the 18,000 miles driven. So I did the calculation right here. And you will come up with 0.5 or 50 cents per mile. Then it's given above that the variable cost per mile is 13 cents. So I'll bring that down. Add those together. The average cost per mile for operating this vehicle is 63 cents. Now in the second question, it says which costs are relevant in the decision making. The relevant cost would be any variable cost, and in this case, it would be the variable cost of 13 cents per mile. If none of the fixed costs can be eliminated, you would still incur those, whether you had the vehicle or not. In this case, we're going to assume none of the fixed costs can be eliminated, so therefore they are irrelevant in our decision making. So let's go ahead and talk about the first type of decision that a company may make. Add or drop. For example, JCPenney's for a while sold appliances. How did they decide if they wanted to add appliances to the product line? Or they did ultimately end up dropping appliances. They no longer sell those in their stores. How did they decide that? Or how does a store decide to keep a store open or close a store down? Okay, we're going to take a look at 3 different types of racing bikes. Bike A, Bike B, Bike C. If you notice, according to our information here, Bike C has a negative operating income of $22,300. So you may think immediately, we need to drop Bike C. But that may not be the case because Bike C could still be helping to cover some of the fixed costs that we can't eliminate. Like, for example, maybe all 3 bikes are sold in the same building, so we wouldn't eliminate any rent. So I like to do what's called the contribution margin approach. Start out with your contribution margin loss if you eliminate the Bike C. Bike C contribution margin, your C is $100,000. If I eliminate Bike C, I will lose $100,000 in contribution margin. Next, I want to take a look at any fixed costs that could be saved. Okay, in this case, it does say that the advertising is traceable. So that means the advertising expense is directly related to each bike. So therefore, if I no longer sold bike C, I could eliminate that $20,500 in fixed advertising expense. Okay, so I'm going to put that here. Next, we'll look at depreciation on special equipment. It doesn't say anything about any of that being eliminated. It could be some store equipment to store the bikes. So therefore, none of that fixed cost could be saved. Next, we'll take a look at the salaries of the product line managers. We're going to assume that if we eliminate a bike, we would eliminate that product line manager. So the product line manager salary for bike C is $35,200. If we no longer sell bike C, we would eliminate that product line manager, saving $35,200. The rest of it is allocating common fixed costs, like maybe rent, etc. So none of that could be eliminated. So these are our two fixed costs that could be eliminated. So if we eliminated bike C, we would save in fixed cost $55,700. Now remember, we would lose $100,000 in contribution margin. So I'll start with a negative $100,000, add the $55,000 that I would save in fixed cost, and notice that I still have a negative $44,300. So if you still have a negative number, in this case we do, no, bike C should not be dropped. If we did drop bike C, our overall company net income would actually go down by $44,300. So therefore, we should keep bike C. We'll move on in the next videos to some other types of decision making done in business.